stocks. Joining us to discuss what's working in the sector is Gene Munster, founder and managing partner of Loop Ventures. Gene, good morning. It's such a familiar story. We've talked about it multiple times about how there is, from many fronts, some pressure on the business models of big tech companies and their business practices, and yet investors basically say high sustainable profit margins, growing pie in digital advertising and e-commerce. Why should we worry? Should they worry?
Well, near term, yes, because ultimately these impact the near term psychology. And I think the core, Mike, is just to invest in great companies. Great companies are those companies of products that we can't live without, and we're willing to spend more money for those products. So we think about Amazon, Apple, some of the kind of iron corners of this. And so China is an important X factor in terms of companies like Apple and understanding the supply chain. But ultimately, to answer your question is, what should investors worry about? They should worry about identifying, again, these great companies, thinking about how their lives are going to evolve and which companies are going to power that evolution.
In other words, the great companies that are in demand by consumers, whatever happens in terms of, look, if Google has to stop kind of privileging its own kind of search results or some kind of tweaks around the edges of how they do business, you don't think that ultimately really pinches them?
Historically, it hasn't. They've navigated that in Europe. They've navigated some of that in the U.S. It is, again, kind of a near-term consideration, but ultimately, again, we anchor ourselves in which products are we can't live without and willing to pay more. Google is one of those products. I would describe that as the oxygen of the internet, something we can't live without. I think the definition of a great company is Apple. Those are products that ultimately you can't even get a hold of right now, with Mac and iPad being a month delayed. It's good for the September quarter.
I was wanted to drill a little bit into the Apple story here, just because, obviously the stock had just an incredible run into like September of last year, sideways for 10 months or so. Now it's broken higher again. And I think there's a sense out there that it just acts as, it's partly safety and stability. It kind of rallies with the bond market. Obviously, they've got long-term cash flows you can raise the value of if you feel like it today. But what is it going on company-wise, product-wise, that we should be aware of that's also part of the story?
Well, I think at the essence, the core of this is a belief by investors that the March quarter was as good as it gets. I've followed Apple for a long time. I would describe it as the best quarter that they've had in more than a decade. And I think the piece that's missing, to your point, is that I think the best days are still ahead of the company. Whether it's 5G, augmented reality, what they're going to do in healthcare, I think in transportation, other additional services. And so what does all of that mean? How does it all play together? Is this can continue to be a growth story, which I think can power earnings higher. The street's looking for about $5.50 for next year. I think that number is closer to $6. And when you put it all together, I think that this is a $200 stock, which is called 40% upside. I do want to point out, I've been bullish on Apple for a long time. I made a prediction this year that Apple would be the top performing FANG stock. And that's probably not going to happen. Google's up 44%, Apple's up 9%. But if I set aside that prediction, which probably isn't going to happen, I believe that Apple is going to be the top performing FANG in the back half of the year, because ultimately I think it can get a lot better, and I think that this company is best positioned of all FANG.
Shepard Smith here. Thanks for watching CNBC on YouTube.